You take those moving averages. Do you look at the moving averages, or do you give caution by a non-farm statistic of 103 and a 2-month payroll revision of -50? Is it a 53,000 month lousy, or is it a better report than that?
Well, it's lousy, and I do look at moving averages, too many to tell you the truth, 200 day and several years in many cases. But yeah, I think this is a weakish type of report. It's true that, and I would have said going in, that wages were the key consideration. 0.3 was what was expected over a 0.1 last month, so that averages out 0.2 and 2.7 on an annual basis, which isn't much change. And so, you know, I would think this makes for a more cautious Fed, especially in light of the global trade situation that we see on an overnight basis. We're just going to have to see, but I think the Fed will be cautious going forward. My forecast has always been for a 1 or 2 hike 2018 type of year.
Bill Gross, if we got wage growth, as John Ferro mentioned, spot on, you've got to take inflation out of that to get to real or inflation-adjusted wage growth. Do we have inflation-adjusted wage growth?
Well, I don't think we have much, and I've got an interesting chart in front of me. You can't show it, but it starts in the 1980s. It looks
good. Oh, Bill, it looks so good on radio. That chart on radio is gorgeous. Bill, continue.
Well, let's talk about it then. Since 1980, real wages have flatlined. It's almost like this patient is dead, and real output has basically doubled. And so where has that productivity gone to? It certainly hasn't gone to wages. It's gone to corporations, and that's good for stocks, I suppose, in terms of earnings. But if the Fed's goal basically is to get wages up and to get that inflation rate at 2% or more, I don't think they're really doing much of a job.